Good morning, ladies and gentlemen. Well, the risk dial calculated manually is still negative. It's about -30 and no change from last week. I still think a lot of two-way volatility and hopefully the yield curve is going to show us some direction now. And I will dive straight in with bonds, but I think the prospects for all asset classes are very, very uncertain. In fact, I can't remember a time with so much uncertainty. Let's dive straight in and see what we can expect. The yield curve is, or should be, on the cusp of giving a clearer signal. This is the 530s, and as you know, I'm looking for a steepening. This 20 level is going to be absolutely key on the weeklies. On the dailies, we managed to close below the previous low at the 3 o'clock close, indicating that the pressure is going to be on the downside. Why should that be? Well, to me, the Fed just was not hawkish enough. Now, is that a good enough reason to get into a steepener? Maybe, maybe not. My level of confidence in this position is actually very low. I know that if it goes through zero, I'm out. I just don't know what is, my level of confidence in any position at this stage is very low, simply because the markets are going to do very volatile things for very strange reasons. And I think the liquidity is absolutely minimal out there. Things basically ping pong from level to level without too much reason. It just whatever position people have. Now the fives, tens are the ones actually which gives me the least confidence. I want to see the fives, tens through this 11 level to have any confidence in the fives, 30s or increased confidence. I think we will test it, but that will probably be a good time to get out of the fives, 30s. So really, I need to see the market trading below these levels to have any confidence at all that I'm reading the yield curve right. The individual tenures are basically poised on a knife edge. I've switched to weekly charts because there's absolutely no point in looking at daily charts. The swings are so wide. And these are the fives. Basically, if we go through this 308, 309 level, if I go back in time, there is absolutely air all the way up to 350 odd, and then even 4% and higher. These kinds of levels, and that's 435. You can see how violent things can get and how completely offside you can be in a yield curve play within hours, because it's just very, very illiquid out there. And we've reached levels, if we go back, that basically tell you that things can get very, very violent indeed. Basically, above 308, there's air for 30, 40, 50 basis points. Much the same in tens. If we go through 323, we're going to 360, and above there, if I go back in time, there's absolutely nothing until this kind of level, which is 460. It really is potentially violent to the nth degree. I don't know if you can even calculate what these differences in yield do to other asset classes. These are 20% moves in bonds in terms of going from say 3 to 4%. That's 25%. These are moves which are going to absolutely kill a whole load of other assets. And the same thing in 30s. Basically, I think it's almost a given that we trade here around 345. Every time it's done it. And after that, we are looking at, very close to 4%, if not 4%. Now, 4% in 30s is brutal. It just is an incredibly high level to discount. We were at 160 not a couple of months ago. To go to 4% and have to discount other risk assets by 4%, mathematics tells you that things are going to be very, very different in a few weeks' time. Now, why would that happen? I think illiquidity is one factor. The other factor is that people can lose confidence. And finally, I think it's just liquidation, just selling. When people don't know what is going on or why it's going on, they de-risk. They have to de-risk mathematically. When VAR gets to certain levels, they don't want to hold positions, and things can get very, very weird. Here you have a chart of TLT, and it basically broke the support that I have at 115. Every time it's done that, it's basically gone to roughly par 101. And that, is brutal. That indicates that 30s are going to go to close to 4%. Now, what is interesting is that you have 1, 2, 3, 4, 5 weeks down, and we've had 5 weeks down in the S&Ps. So basically what it tells you is that bonds, TLT bonds and the S&P are basically tied together. What one does, the other one will follow. And that tells you, even if we have 1 or 2 weeks of consolidation here, if the path of least resistance is to 101, that tells you where risk assets are going to go as well. And it's not just in the US, it's just as bad in Europe. You can see this level here around 36 basis points. We start going through that in Schatz. There's nothing, there's air, all the way into 1%. Can you get there? Without a doubt. If we go to 5s, we will see much the same. And, these are all monthly charts now, because there's no point in even looking at dailies or weeklies. We're so far away from any semblance of normality. Here, we are almost bound to get to 111, 118, 120. That's where the real resistance lies. If we look at the bunds, we're right at resistance here, but the next one is 168. So that's another 50 basis points away. It's mirroring what I showed you in the bonds in the US, in the 10 years, in the 30 years. The next level of resistance is a long way away. And the discounting factor gets parabolically worse. It's just going to be a very, very uncertain period until we find some sort of equilibrium. France is still the clearest chart, and that to me says anything that we start trading through 170, we're going to 247. Another 70 basis points. that is the kind of move that you are looking for, potentially in all these markets. Something needs to calm these markets at these levels, and I just don't know what it's going to be. The Fed didn't do it. If CPI is bad next week, I just don't see an alternative to the markets doing these kinds of moves. And these are massive moves. These are moves that absolutely kill all the risk markets. The dollar just doesn't want to calm down. And really, if the bond markets give in and start going 40, 50, 60 basis points, the dollar's not going to calm down either, is it? I mean, there's absolutely no chance. We are breaking levels that we haven't seen for basically decades. And, going back in time, every time it's gone through this area, and this is where we are, it's gone, well, much, much, much higher. What are the levels? Well, we're looking at 106 and then 111 and then basically all the way to 118, 120. So we're looking for a 20% potential move. Well, just less than 20% from where we are. This is the kind of volatility that you could easily see, and really nothing to stop it, because if the bond market's the anchor and the 30 years starts going towards 4%, this kind of volatility is almost guaranteed in every single asset class. In terms of Euro USD, you can see how important this 103.39 to 104.37 area is going to be. Any close below there, and basically if we go back in time, and we have to go back an awful long way, you are looking at basically sub par, and then it's just a cascade into the low 80s. That is the kind of volatility you are potentially looking for. You haven't seen this since 2000, and it's quite probable that we won't see this for another 20, 30 years. But in the meantime, I think the odds that we see something like this are increasing every week. And every week that the bonds don't stabilize is a week that says more volatility is coming. Gold is probably the asset class which is going to be the most stable, i.e. the least volatile. With the dollar going berserk and the bonds not stabilizing, you can't really be bullish of gold. On the other hand, it's a question of degree, isn't it? If the bonds are going stupid because the Fed has lost some credibility, or is not, the market figures that it's not fighting inflation fast enough or strongly enough, or because commodity prices are going up, or because there's a general loss of confidence that the central banks are going to intervene. Money has to go somewhere, and probably gold is going to be the most stable asset class out there. On a weekly basis, really, 1790s to 1760s are where I would not expect it to trade through for quite a long time. And on a daily basis, I think anything down here towards the 1830, 1810 level is probably a good level to pick it up on a spread to something else. i.e. I would much rather have gold at 1810 to 1830 than I would want to own bonds or equities. More so because DBC gold is at, historically cheap levels. I wouldn't say it's hugely cheap because you can go back all the way to whatever. You can go, here we go, 2007, 2000, can it come down to 4? Yes, it can. But you would have to have, I would argue, much higher commodity prices for that to happen. And much higher commodity prices, to me, are unlikely without a huge element of demand destruction. So I find it very hard to believe that gold is going to fall much, much further against commodities. And I will stick to that view. I will buy gold on dips, simply because I don't think that commodities can really sustain. This is DBC, and it's trading in a sideways pattern, looking to break up towards 2973 and potentially beyond. But at some stage, demand destruction has to take place. And gold at some stage will be buoyed by that demand destruction when people switch out of commodities and back into gold. So I really am in every which mind about any asset class, but the one that I feel is going to be the least volatile, or where you're going to lose the least amount of money, is going to be gold. And I keep on looking at the copper chart simply because I think it's becoming a little bit of a leading indicator. And I will also show you the gold copper chart, which is, one of Gundlach's favorites. We haven't closed below this 4.1735 level since the first quarter of 2021. If we start closing below there, that has to be a sign of massive demand destruction and potentially a recession in the economy, which has to stabilize bonds at some level. We will see what that level is. I would prefer to see copper now over the course of the next 3 or 4 months start breaking down. And when that happens, I think that will be the signal that bonds stabilize. But they could very well stabilize from the much higher levels that I showed you earlier. And here we have gold against copper and TLT. As you can see, gold against copper basically peaked here in very early August and then led, or confirmed rather, this whole move in TLT. Then it went sideways and the market, basically TLT, recovered a little bit, and then TLT went straight down, and gold copper has not confirmed it, but it's going through. If we start breaking through these levels of the previous highs, which basically we were here, I think that will be a sign that basically bonds are doing something irrational, that they are in a blowout phase, and copper has to be a leading indicator. As I said, I think gold will do almost nothing. It will be the least volatile, but if copper starts breaking down, that will be my signal of some demand destruction, and that will be my signal that the move in bonds is becoming irrational, or that the stock market is going to get hit very hard on top. So rather than giving you the direction of bonds, what it's going to be saying is that bonds relative to equities are going to be cheap because there's demand destruction, and demand destruction leads to recessions, leads to lower prices in everything, and which is good for bonds as a relative, in a relative way compared to equities. So it'll tell me really to start looking to put some money to work in bonds relative to equities. From a fundamental point of view, equities are not expensive. But what I have never seen is an acceleration of the Blue Angels, i.e. expectations of even higher forward earnings and the market falling in multiple terms. It really is something which I don't think I have ever seen, and I am not sure how to interpret it. Either the expectations for forward earnings are completely unrealistic, but I can't imagine that every single analyst analyzing every stock in the S&P 500 is going berserk and in terms of direction, and that that's very hard to believe. So I really don't know, and this is why I'm so uncertain, and I think there's going to be so much two-way volatility that I just can't square those expectations with lower multiples. Lower multiples make sense if bond markets are going to go berserk, but if bond markets are going to go berserk, then these forward multiples have to come down as well, because there's going to be demand destruction, there's going to be all sorts of incredibly bad things happening. And, so basically what we have to do over the course of the next several weeks and months is actually resolve that dichotomy. These have to start coming down for us to be able to go down towards times 16, or to compress the market. This is just unsustainable. This has to change. There's no, of that I am certain. There is absolutely no way that this can continue with having, sort of higher FE, higher values and accelerating values of the forward earnings, i.e. now we're expecting 240, 250 in terms of earnings, and we're going down in multiples. That makes no sense. And that has to absolutely change before we can reduce the level of uncertainty that we have. Callum Thomas is a very thoughtful man, put out this email today, which basically illustrates why we have this dichotomy. You have distribution of S&P 500 daily returns, the day of the Fed plus 3%, the day after minus 3.6%, and you can see that we are basically trading either side of the tail, which is not normal. But the reason is the yields, the bond yields. I won't go through the whole email. I'll put it in the I'll attach it to this video so you can go through it, and what that shows you for the potential implications and the volatility that is to come. There are so many indicators which are so far apart now that it makes no sense. Something has to give, and something has to give in a big way. Before we go on to what is happening, I want to show you what is not happening. This is HYGH, which is basically HYG with the interest rate component arbed out of it. It's not making new lows. So basically credit spreads are not making new lows. That to me is important, and that is probably why you are having these wild swings in in equity valuations and prices. Unless credit follows, there is going to be support for equities, because if the only thing which is moving is interest rates, that compresses the valuation. But unless credit follows it, then there is underlying demand underneath the market all the time. Credit has to confirm the down move for there to be no bids in equities, and that is not happening. So I think you have to bear that in mind and have this level marked as a very important level, unless we get a confirmation from credit that we are breaking down, and and that happens. Just a move in bonds is not going to compress the equity market nearly as much as if this confirms. If this confirms, there's not going to be any bids for 1-2% in equities. Where are the moves coming from in equities? They're coming from the sectors. They're coming from XLY. New highs, SPY over XLY. We're now at levels that basically we haven't seen since, a long time ago, and this is the COVID spike. We are now basically to where we were just before the COVID spike. That tells you the mood of the market. That tells you what the worry of the market is. The worry of the market is that the consumer's just going to throw in the towel. Possible. I'm beginning to think that at some stage this is going to get very overbought, but even this chart, which is equal weight consumer staples over consumer discretionary, made new lows on Friday. And really, if we start breaking through here, you can see how far back and how important this level is. If we start trading down here, it's basically saying that we're going to go a lot lower, and that would be why would that be? It's because interest rates are going much higher, and the consumer just won't buy housing, won't buy anything associated with housing, and people will look for the safety of the consumer staples. The staples are going to get hit as well because the discounting factor is moving, but they're going to get hit a lot less than the consumer discretionaries. And of course, it's not only XLY that's getting hit, it's also XLK, it's technology, anything which has to be discounted back to the current value of bonds. This is NDX over DJI, and which I tweeted to you on Friday. These are very, very important levels. You can see that basically this is the acceleration during COVID, and we are back to those levels. If we start breaking through, I think we go probably another 3%, 3-4% of outperformance of DJI over NDX. And that just basically means that the sectors which are defensive are going to be much more in demand than sectors which are growth, high beta, and that by itself gives you the direction of the overall stock market. And of course, NDX is by far the weakest of the indices. It's the one that did close below the previous lows, and it's the one which has the most aggressive targets. Even if you say that this is just a simple ABC correction, you're looking to fill in these gaps that we had around 11.5, 11.2. That's the kind of level that you are looking for eventually. It basically, everything points to the fact that bond yields are forcing a repricing of the technology sector, or even the growth sector, let's call it. NDX really did nothing that I thought was unexpected last week in terms of ranges. What I'm beginning to find a bit odd is that we've had 5 down weeks on the trot. That is quite unusual. In fact, in NDX, I found a period of 8 down weeks during the 2002 period, which you really, you wouldn't even expect. But we're getting close to extremes that we have been going down in time, and that is why I think you are going to get this two-way volatility. I think that while every time we close the week below 42, 47, the pressure is still very much on the downside. We are trading in a very orderly way. At some stage, the odds are that we get disorderly. I still think this 39.43 to 38.70 area is going to be huge support, and the likelihood of a 10% bounce from those levels is actually very high, and it's going to be an interesting time. That's all I can say. 32.47 I think is the level that's, if we keep on closing below, keeps the pressure to the downside. For the very short term, we do have a divergence between what stocks did and what volatility did last week. If I just enlarge this period here, you can see that volatility closed down a good 3%, while stocks also closed down. And that is the effect of two-way volatility, that the end result is not very much. From a realized volatility, from a close-to-close basis, the market doesn't move very far. What did we move last week? Not even 0.5%, but the ranges were very high. So that means that the extremes of the range of volatility are very high, but the close is also lower than what the equities did. To me, selling spikes in volatility at this stage is a good trade, simply because I think that at some stage we have an up week, because 5 down weeks in equities is very unusual. So really, I'm looking for volatility to keep on coming off relative to equities. I think equity spikes and volatility dips down into the low 20s are huge buys for moves back up into the 30s. But that is this dichotomy has to be resolved at some stage. We probably have a huge spike in volatility and which is going to be a massive sell, because the stock market is going to then readjust to equilibrium levels that are cheap in every which way. They're cheap in multiple terms, and they're also cheap in expectation of forward earnings terms. And that is going to be a massive sell in volatility, and volatility is going to come all the way back down into the teens. Not yet, I don't think. I would love to see this panic if we go back to the ES chart. I would love to see the panic in the monthlies and get the monthlies down, but I just don't think it's going to happen very much. I don't think that we're going to get into the 3800s. I think the 3900s before we have a very violent move back up to 4200, 4300 is much more likely. What is important to understand is that this is not a huge move in equities as an asset class worldwide. The Nikkei is hardly moving, and then you have to ask yourselves why. Well, because the dollar is taking a lot of the pressure out of the Nikkei, so the currency is depreciating, And secondly, interest rates are being held at 25 basis points by the Bank of Japan. So the elements which make for volatility in the US are actually making for calm in the Nikkei. So I very much doubt that if the Nikkei and Europe are calmer than the US can go absolutely berserk for the time being on the downside. And therefore, next week, simply because we've had 5 down weeks, I'm hoping to get to a level that I can buy some call spreads. At some stage, the bond market has to calm down, but I'll be looking at that copper spread as the main indicator for demand destruction, and then I'll be fearful for equities, and only then. And with that, onto the buy sheet. I've updated all the levels. What am I afraid of next week? I'm afraid of a disorderly liquidation in bonds. If that doesn't happen, I think equities will be fine, and we'll probably have quite a lot of two-way volatility all the way back up to start closing these gaps into the 4200s. It's not going to be easy. It's going to be a very, very volatile period two ways, and narratives are going to keep on changing. Don't be married to positions. A lot of things won't make sense. A lot of liquidation will be done at ridiculous levels for no reason that anyone can see. So we'll try to navigate that environment because that's what we have. Keep positions lower and be nimble. I'll tweet you on Monday. Have a wonderful weekend.